The 2008 global financial crisis was a catastrophic event that shook the very foundations of the US economic system. It was pretty much a huge oversight by both the federal government and investors alike, which caused the downfall of numerous banks, decimated the housing markets, and caused millions of people to lose their jobs, their homes, and their life savings.
I think this is the most significant financial crisis in the post-war period.
There are fears this sell-off will continue on Wall Street.
In this video, I'll be going over the preceding factors leading up to the crisis, the spark that caused the crisis, the doomsday, the aftermath of the disaster, and my personal outlook on whether or not we are heading into a housing collapse ourselves. Let's get into it. In the years leading up to 2008, two major events occurred that shook the entire financial world. The first was the dot-com bubble, and the second were the 9/11 terrorist attacks. Global markets tanked worldwide, with some of the hardest hit being the Nasdaq exchange, which subsequently fell 75% over the span of just 2 years. As a result, the central bank of the US, known as the Federal Reserve, or just the Fed for short, actually began to lower interest rates to try to get consumers and businesses to borrow more money. This was the government's way of trying to inject cash back into the economy, as when more people have more money on their hands, they are typically more willing to spend it. Businesses start making more revenue, so they start reinvesting profits, and more cash is being circulated around the markets. This helps encourage employment, promote spending, which also increases tax revenue. In June of 2003, the Fed lowered the interest rates to 1%, a level that has never been seen before in US history. Now this provoked hordes of frenzied buyers who desired to capitalize on these historically low interest rates to buy one thing: real estate. US housing prices have been rising steadily over the last 2 decades, and many held on to the belief that these prices will continue to rise indefinitely. In the second quarter of 2003, total US mortgage loan originations amounted to a whopping $1.1 trillion, which was an increase of 127% since quarter 2 of 2001. Home ownership peaked at 69.2% in June of 2004, the highest levels ever recorded, and this was where things started to go downhill. Due to the wide availability of credit and the Fed's new policies to increase loaning, banks and lenders started approving loans to individuals in poor financial positions in credit history. This is known as subprime lending, which grew in popularity due to the historically low interest rates and many of the homeowners' blind faith in the housing market. A good portion of these homeowners were likely unaware of the full risks associated with these quote-unquote investments and were locked into predatory mortgage contracts that they could not really afford to pay back in the first place. These contracts often contain extortionary terms such as high interest rates, excessive fees, and teaser or adjustable mortgage rates that often started out at low interest but would quickly balloon to uncontrollable levels. The subprime mortgage market grew so quickly that in a short span of 5 years between years 2000 and 2005, the market rose 781% from $80 billion to $625 billion at its peak. But what does this all mean? Well, it pretty much meant that there was now a huge number of people in poor financial positions that were never meant to be eligible for a loan in the first place borrow from these subprime mortgage lenders that often signed them under unfair and extortionary terms. I think you can see now why this wasn't going to work out. Now keep in mind that a good percentage of these people may not have much formal experience or education regarding real estate, finance, or investing in general. In fact, the most significant source of exciting and novel news was either from the news headlines or their close friends. So there is now a massive surge of home buyers in the market that is actively looking to purchase property. However, houses often take years to design, build, and finish. In the language of economics, this meant that there was a spike in demand, but the available supply could not increase at a proportional rate. If this continues, there will be more and more people competing for a dwindling number of houses. The housing market was never prepared for a surge of demand of this scale and simply could not keep up with the huge influx, and this caused US home prices to spiral out of control. By early 2006, the influx of home buyers had caused certain property prices in metropolitan areas to rise over 90%, with home prices in major cities such as Miami taking the lead at a staggering 120% increase in certain areas. As the real estate market ballooned, the fervor of public media began to spread the news further and further, and before long, headlines filled the latest information regarding soaring home prices were in everyone's mailbox. Consumer optimism peaked, and everyone fought for a share of the pie. In fact, the US real estate rush of the 2000s even began influencing markets in overseas countries. It was the next big thing. It was the path to riches. It was the market that had never dipped in the last 20 years, and it was guaranteed that if you put your money into real estate, you would be like everyone else on the news headlines, right? You would double, triple, maybe even quintuple your investment because, hey, look at the people around us. Look at the amount of money they made. We can make that, right? I mean, come on, it's real estate. What can possibly go wrong? However, as we all know, what goes up must eventually come back down. You've probably heard of this concept within the realm of economics and investing known as a bubble, such as the Great Crash Bubble of the 1927s, the dot-com bubble of the 2000s, and of course the recent 2021 cryptocurrency bubble crash. Bubbles are characterized by sudden spikes in the prices of an asset that exceeds their intrinsic value, which is a measurement of the asset's utility to its consumer. In the case of real estate, a house's intrinsic value is often determined by factors such as the physical features of the house. How big is the house in terms of square footage? How many bedrooms? Is there a backyard? Etc. The neighborhood environment. Is it located next to a busy road with a lot of noise pollution? Or is it located next to a calming park? Accessibility to infrastructure. How close is this home to public transport, or hospitals, or supermarkets? The supply and demand of housing in its location. High population density areas such as metropolitan areas in cities usually has higher home prices because there's simply more people crowded in limited space. Housing prices vary depending on these factors, and the prospecting homebuyer is looking to maximize the utility factors while keeping costs to a minimum. This system is what prevents buyers from paying too much for a house, because at a certain price point, the utility offered by the house just isn't worth the price compared to other houses on the market that offers more features and more utility. In the case of 2008, the rapid onset of subprime mortgage loans caused the rush of inexperienced homebuyers to suddenly appear on the market, and they were itching to get their hands on property. Here's the problem. It's questionable whether these people actually knew what they were getting themselves into. Eventually, as asset prices continues to increase, we get to this point known as euphoria, which is when asset prices skyrockets, and it could be said that caution on the part of investors is mostly thrown out the window. However, this stage does not usually last long, and eventually someone will discover the huge discrepancy between the asset's intrinsic value and the highly inflated market price. As 2006 approached, investors and economists began worrying about the highly inflated real estate prices, and news headlines began to show early signs of distress. To combat the house buying frenzy, the Fed had increased interest rates to 5.25%. By quarter one of 2007, the median price of single-family homes had risen over 70% since 1998 to $257,400, which, when adjusted for inflation, amounts to a whopping $367,000. Now, homeowners who had bought property prior to the real estate rush were nonetheless exhilarated. However, these extremely inflated real estate prices meant that many new prospecting homeowners could no longer afford many of these homes, even with their mortgages. This was a massive problem. As 2007 rolled around, housing prices became more and more unaffordable, and demand started to decrease. For the first time in nearly 2 decades, US housing prices actually began to consistently drop. Panic struck the hearts of the American population. As homeowners began noticing the decline in demand, many began to sell their homes in fear of further price drops. However, in 2007, the home ownership rate was still at 68.5%, which meant that there was a huge surplus of sellers and not enough buyers. This wasn't the end of the world for homeowners who qualified for a mortgage in the traditional way, where your assets, your income, your debt, your credit history, and other factors are strictly assessed by your bank to see if you're actually eligible for a mortgage in the first place. However, this was lethal to those who were forced to borrow from subprime lenders because they simply did not boast the financial circumstances to qualify for these standard loans. Remember the predatory terms these victims were often signed under? Well, many may not have had stable jobs or sources of income to finance these loans in the first place, where they were relying on the housing market's continuous upward trajectory to eventually refinance and sell the home at a profit. However, this meant that if the market does not go up and they are unable to sell their homes at a profit and repay their debt, they likely won't have the ability to pay it off at all. This was precisely what happened. After housing prices peaked in Q1 of 2007, the bubble eventually gave away, and the housing market experienced a decline for 2 straight years, where the median price of a single-family home fell roughly 19% during this time. A 19% decrease may not seem like much, but it meant that in Q1 of 2009, the median home price had fallen to pre-2004 levels, so those who had bought real estate between 2004 and 2009 and subsequently sold it during that period of time would likely have lost money. Remember that this is an average decline in price, and some of the hardest hit areas being metropolitan areas such as California and Nevada, which subsequently saw a 50% drop in home prices. But why couldn't these homeowners simply hold on to their property and wait for the market to recover instead of selling it at a loss, right? It's not that simple. First of all, as housing prices declined, many homeowners found themselves owing more in mortgage debt than what their homes are now worth, a situation known as being underwater. Remember that people who borrowed from these subprime mortgage lenders were likely not in the best financial situations to begin with. They pretty much needed to sell their homes at a profit in order to pay off their debt. But instead, their homes have now declined in value. So how exactly are they supposed to finance these monthly mortgage payments, right? In fact, many simply could not afford to hold on to their homes for an extra year or so because they simply did not have the financial capabilities of doing so. When someone can no longer afford to pay back their mortgages, this usually leads to something known as a foreclosure, which is when the lender seizes the borrower's property and sells it on the market at a hefty price reduction to try and recoup their losses. With the rise of these forced sellings, it worsened the already terrible housing crisis even further, and the years spanning 2007 to 2009 were especially gruesome for many Americans. Perhaps one of the most infamous incidents that occurred during the 2008 financial crisis was the collapse of major banking organizations, such as the Lehman Brothers and Washington Mutual.
Lehman Brothers, a 158-year-old firm, filed for bankruptcy. Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
But how exactly do these mega banking corporations collapse with billions of dollars under their portfolios? Well, there are a whole combination of factors. The first factor was that the large majority of banks held positions within mortgage-backed securities, which are bundles of individual mortgages that are pooled into a tradable financial asset. Investors, such as banks, can purchase shares of these mortgage-backed securities to own a fraction of the total mortgage pool, which also shares revenue based on the cash generated by these mortgage payments. It's pretty much a stock index that tracks loans on houses. Many subprime mortgages were also bundled into these mortgage-backed securities, which meant that as more and more homeowners were no longer able to finance their monthly mortgage payments, the value of these mortgage-backed securities plummeted, and so did the portfolios of these banks. The next factor was that as an increasing number of foreclosures occurred, banks were left holding on to houses that were rapidly declining in value. Even worse, as people panic sold their properties, it drove up the available supply and it became extremely difficult to find a buyer. Around this time, the interbank lending market, a massive network where financial institutions loan money to each other, rose up due to concerns regarding cash flow and liquidity. This worsened the problem for banks, as the ILM is one of the most immediate sources of liquid cash banks often have access to. Perhaps the final nail in the coffin came during March of 2008, when fifth largest investment in securities trading firm Bear Stearns collapsed due to their over-leveraged positions on mortgage-backed securities. Although exact numbers are not known, it is estimated that they held between $10 to $20 billion worth of securities and were leveraged at a ratio of 33:1, which meant that for every $1 of equity, the firm had $33 in debt. To give you some perspective, the Federal Reserve estimates that during 2008, the average leverage ratio for banks were only 12.6:1. As liquidity problems worsened, rumors began to spread about the firm's impending collapse. On Friday, March 14th, Bear Stearns stock tumbled more than 47% in just one day. 2 days later, Bear Stearns was acquired by JP Morgan Chase for a fraction of their opening stock price at just $2 a share. Alarmed by the rapidly worsening state of these financial institutions, investor confidence crumbled, and account holders began to withdraw money out of their bank accounts in fear of further economic collapse. This messed up banks even more. Following the collapse of Bear Stearns, IndyMac Bank collapsed on July 11th, Washington Mutual and Wachovia in September, and of course, the Lehman Brothers on September 15th of 2008. Other notable bank collapses were Merrill Lynch and Countrywide Financial. By 2008, GDP growth had stagnated before falling down to negative values. The US was in a full-blown recession, with unemployment rate peaking at 10% along with more than 15 million unemployed Americans by 2009. To put it simply, there are now a lot more homeless and hungry people. It is estimated that the global financial crisis wiped out nearly $10 trillion worth of financial assets, whether that be from defaulted mortgages, foreclosures, or just general depreciation. It took the US housing market roughly 4 years to recover from this disaster. By 2013, median home prices were back at all-time highs and the economy was back on track. Since then, the real estate market has been doing quite well, which leads me to the final question. Are we heading into a housing collapse ourselves? If we extend the US median single home prices to the last few years, we can see an alarming amount of growth. Between Q1 of 2020 and Q4 of 2022, a span of a little less than 3 years, the average home price rose an alarming 29.7%. Now, there are many complex factors that contributed to such sky-high growth rates, but that's for another video. To put it simply, it was a combination of low interest rates, transition to remote work, and a whole lot of governmental aid. However, unlike the global financial crisis, the majority of homeowners today have excellent credit, a lot of equity, and are signed under fixed-rate mortgage loans. Documentation, such as asset portfolio and income statements, are strictly assessed before loan approval. This means that the housing market won't be subject to a crazy surge of subprime buyers that don't really know what they're doing. The US housing market is likely to cool as housing prices become more and more unaffordable. However, it is highly unlikely that a crash rivaling the global financial crisis would actually occur in the next few years. So, should you invest in real estate for 2023? Well, always remember that you should not try to time the market. Whatever your goal is, whether that's long-term portfolio growth or maybe something like house flipping, you should always determine your financial position and consult an expert before investing. Personally, because the market prices are quite inflated, I do anticipate a minor drop in home prices. Nonetheless, do your own due diligence, and of course, most importantly, invest freely. If you made it to the end of this video, I thank you to the bottom of my heart. I am in the process of rebranding my channel, so I'll provide more face content, none of that automation, faceless stuff. So I do aim in the future to provide the most high quality, entertaining, but also knowledgeable content just for you guys. I mean, finance doesn't have to be hard, right? Investing can be simple. And if you have the best financial tools and the best financial knowledge, you can invest freely. And that's my purpose of this channel. So it would mean the world if you can share, like, subscribe, comment, tell your friends, whatever you want to do. Anyways, thank you so much, and I'll see you guys in the next video.